Good morning, folks. Welcome to this week's edition of Back to the Futures. And as we always like to start out, first, a quick overview on risk, because really this is the most important part of your trading game. You're not managing your risk, you're not going to last. And if you don't last, you're not going to be able to enjoy what it is to become a disciplined trader, start building your wealth over time. Also, if you don't last as a trader, you're probably going to be more scorned about finance in general. You're probably not going to want to be involved as much with investing or otherwise. That sort of PTSD of blowing up an account, it can linger in other areas of life, can create self doubt. So instead of being too confident early on and creating self doubt later, start with a humble attitude. Only risk as much as you're willing to lose. I think that's one of the most important things to embrace early on, because at the end of the day, you don't want to learn about the fourth shape. You don't want to learn about what it is to try to recover from losses that can be really, really mathematically difficult to recover from. And I've had folks in my replies who are investors saying, "Oh, well, even with this, all you have to do is wait for the stock to come back." And I know this is geared more towards traders, this discussion, but just to touch on that, a fair amount of stocks don't even make it. So, I think it's what, like 30 plus percent stocks don't make it after 10 years, probably higher than that. So, holding the stock indefinitely doesn't get you there. Managing risk isn't about just holding until it eventually bails you out. I know that the market's been very forgiving, especially at the index level, for a lot of situations where, one might have entered at a bad level and can get out later, but you can't have that be your baseline. That's not risk management. That's essentially gambling. So at the end of the day, it's really important to take this into consideration with how one sizes their positions. Positions should be sized based on the inherent volatility of the instrument. That's such an important part of this whole discussion. Because that way, if you're trading something like, let's say, natural gas or Bitcoin, you're going to realize you have to use a wider stop because the personality of that asset is much more volatile. That also means you have to use smaller size because the goal is to make sure you don't blow up your account. Well, if you're only risking 1 or 2% of your portfolio, the way you're sizing your positions, the way you're placing your stops, you have plenty of opportunities to keep trading. So I always like to remind people, first and foremost, risk management is the most important part. I know that there's folks out there promising lottos and Lambos and riches and all that, and they don't talk about risk management much. I will talk about it first and foremost because I'm not here to make false promises. I'm here to try to help you survive this game where the odds are against you, where 90% of traders don't make it. We're going to be very upfront about that because if you do want to make it, the first thing you should appreciate is that the odds are stacked against you. And that means you have to take this seriously. You have to treat it like a business because it is. You're buying and selling inventory. That's the shares, the options, the futures, whatever it is you're buying and selling. And your goal is to capture a positive spread repeatedly. That's when you're making a profit on that trade. If you don't dress it up as something it's not, if you don't try to front run the process by focusing on just the goal, like getting wealthy, you have a better chance. It means you're willing to put in the work. That's what this is all about. You've got to be willing to put in the work. It is not easy street. So, with that little soapbox rant out of the way, a little bit about me. Been doing this for 21 years. That is one reason that I feel like I do have the seniority to get up on the soapbox and sort of give that speech once a week. And the reason I do it really is I know a lot of folks are continuing to hurt themselves through their bad habits. A lot of these habits are built on being addicted to dopamine and having skin in the game, over trading as a result, or ego, getting caught in bad trades and just doubling down on losers. These are things that you can overcome as a trader, but it's going to take effort. It's going to take building a process and following that process. It's not enough to just have a strategy. You actually have to practice that strategy routinely for it to mean anything, for it to become ingrained in your process and how you make decisions. So let's zoom out a little bit to the big picture. We all know what's going on in this war. We've probably heard about it nonstop across the headlines in multiple different publications. And it's had a big impact overall. That's to say, the Strait of Hormuz effectively closed, not many ships going through it. That did have a rather profound impact on the price of oil. At one point on Sunday night, West Texas Intermediate crude was up about 30%, which is incredible. That in and of itself was putting pressure on markets. S&P, NASDAQ futures were down around 2% overnight during that session. And really all because this tiny little part of the world that carries about 20% of the world's oil was effectively closed by threats of kinetic action from Iran. And this picture really drives it home as to how close all of this is together. For a while, UAE was seen as this sort of safe haven of the Middle East. So was Qatar, even Saudi Arabia. But when those rockets started flying, a lot of that completely changed. So now we're seeing real estate prices drop by 20%. We're seeing the markets there fall out. We're seeing a whole recalibration of whether that's really a safe place to live. And it's having regional impacts, but it's also having global impacts on the perception of geopolitical risk. This geopolitical risk index shot up to the highest levels since 2022 on the US Iran conflict. And often when it does, that adds some volatility to markets, typically about a 5% drawdown, peak to trough. And then we kind of resume business as usual. One of the things that's really important to remember about war and geopolitical escalation is it typically is a blip in the long-term chart. You get this risk off effect, and then the market starts to more and more calibrate for the fact that the world's at war. And it really begins to ask one big question: how does this directly impact the earnings of companies? And if the market struggles to answer that question in a way that's negative, it just keeps moving forward. So if the war is not going to have an immediate and tangible impact on earnings, the market can kind of look past it. That's one thing that we have to keep in mind. Another is that we were really well hedged going into the war effort that was happening in the Middle East with Iran. Like, this was record levels of put delta on SPX. So this was not a market that was completely unprepared for some kind of orange swan event. But apparently, at least based on what we're being told in the headlines, this is something that we should look at as being pretty much mostly complete, which is good. Markets rejoiced on that. Certainly helped to bring us out of the selling that we had seen overnight into yesterday's session. Amazing to see that session close in the green as well. So now we have markets that are looking past Iran, but we're not quite out of the woods yet entirely. Remember, going into this conflict, there were still concerns about private credit, about stress growing for the consumer, about AI capex. All those still linger in the background, particularly as we got unemployment data on Friday with a larger job cut than was expected. That's something that's going to begin to percolate into the economy and have an impact. It also boosted the unemployment rate, I want to say to 4.4%. So we're starting to see some of the effects here. That is to say, we're starting to see some signs the economy is slowing and that K-shaped distribution of outcomes is it's struggling to kind of keep things afloat. The fourth quarter GDP last year was also quite slow compared to the rest of the year. And last year, one thing that we have to come to appreciate, AI was a really big part of positive GDP contribution. Why does that matter, you might ask? Because as goes the AI CapEx narrative, the economy goes as well. And that matters because we're seeing this year those companies, those same hyperscalers are increasing their CapEx. It's planned to increase over the next couple of years here. And that is going to significantly reduce the amount of free cash flow that's available. In fact, it will account for about 92% of all cash flow from operations, this build out of data centers. This is one reason that private credit markets are starting to get a bit nervous. We're seeing redemptions build in the space. So it's all kind of circular. You've got an economy that in no small part relies on AI that is beginning to slow. You've got that AI capex growth, the largest contributor to positive economic trends last year. And you've got increasing concerns in the debt market that could start to cap just how much of this growth is going to happen as debtors are less willing to take on debt at higher rates and creditors are less willing to issue this debt to these companies. In fact, you've seen Oracle now pivot from borrowing to firing, now planning to fire as many as 30,000 employees to keep the AI capex spending going. So that's all something we just want to keep in the back of our minds as we're navigating throughout this quarter and into next quarter, is that we could start to hear a little bit more about AI capex having an impact on companies. On the one hand, as we discussed, Oracle was perfectly willing to fire employees to try to keep the AI capex growth going. They've also talked about what they call bring your own chip. That is to say, you can come to an Oracle data center, but you've got to bring your own GPU. Another way for them to try to reduce overall costs. Whereas OpenAI has significantly slashed their spending plans from something like 1.4 trillion to 600 billion, which we may also hear more about, companies reducing their overall spending plans, which, by the way, wouldn't be that bad of a thing. We're seeing AI models being able to do a lot more with less parameters. There's been Quen, Alibaba's Quen has put out some very incredible models with Quen 3.5. Those are strong. Minimax 2.5, GLM5. A lot of the stuff that's coming out these days, it's less parameters, and yet it's able to punch way above its weight and into the frontier proprietary models. So that's something that kind of tells us the biggest thing for AI is really the density of intelligence. Scale doesn't win alone. If it did, XAI would be the biggest, most formidable AI company. Meta would be making strides, but scale alone doesn't solve this. It's also about the density of intelligence. How powerful are your models at the size that they're at? And we're seeing over and over that smaller models are becoming more and more capable. We're also in a time, shifting gears a little bit, where liquidity is running low up until just about the halfway point of this month. And it's interesting because this also, to some degree, coincides with quarterly OPEX. So liquidity is low, but it's set to mechanically ratchet higher later this week, into next week, and really into the rest of the month. This also correlates with the seasonality of volatility. We're basically right on schedule with this latest blast, and it's at the midpoint of the month or just a bit later that volatility tends to ratchet lower into April. So that also gives us a sense that that liquidity returning has a suppressive effect on the volatility that has been surging. The last ingredient we would need would be some real stability in the blowup we've had in the Middle East. Another area I wanted to highlight because I think it is incredibly important is that this is a well-hedged market. I wrote about this on my Substack, mayhem.substack.com. You can check it out for free market insights. I put out a lot of great stuff there, both in the notes and on the main site. And this was an article I wrote because I wanted to emphasize that with all the bearishness that was out there, the overall structure of the markets options at the index level were not that bearish. Everyone was already looking for downside. So when I see a market that's basically got fire insurance, I'm less worried about the fire. And that's exactly what kicked in yesterday. When the market opened, you started to see some of these puts being cashed in. You started to see that become an area where liquidity was being added to the market. And then as news of potential de-escalation came in, that was bid into, and that created that potential for a recovery off the lows. So when you're coming into a market that's this well hedged, you can't just short it into oblivion because you're naturally and reflexively going to see a bid, or at the very least, you're going to see downside limited. And that is what we saw over this period from when we started to see the market as well hedged as it was. Every sell down was pretty orderly. And then we started to see, as the pressure built into Monday, more potential for a reversal. Now, I still think we could see some lower levels here, but I just don't think it's this Black Monday type of thing that we keep hearing about every weekend. Now, on the other side, we've got Korea. I just wanted to quickly bring this up. Going into the crash, that 12% down day, which was one of the worst days for the Kospi in its history, we had an absolute mania in the flows. I mean, I've never seen anything like this before in Korea. And that's the kind of thing that sets you up for a crash where you had that down 12% day. I realized the next day we were back up 12%, which I think was the best day in the Kospi's history. None of this stuff is normal for an entire country's stock market to trade like a meme coin, but that is the era that we're in now. And you've just got to be mindful of flows. When people get this excited about anything, it's usually a good time to start being a little more cautious. Let's shift gears a little bit into technicals and momentum. First chart we're going to start off with here is the S&P 500. I don't think we're quite out of the woods. And the reason I say that is we basically tested the bottom of the range on that recovery and rejected it both yesterday and in the overnight session. We did break below that range, and we did so on a weekly closing basis. I think we're still going to head back to these November lows ultimately to resolve what's going on here. The right tail on that, or the outlier, would be we actually see a real de-escalation overseas. Like the war somehow comes to a much more rapid conclusion than what we're factoring for. We did hear some clues about that from Trump yesterday, again saying it was pretty much very complete. But also he said later on that there could be a lot more work to do. So we're kind of left guessing, parsing the tea leaves here. But given this distributive pattern and how we've broken below the range of consolidation, it does seem like the market wants to complete all the way back down to the November lows. That would be where I'd like to start looking at bidding up some of the shares that have been tossed out, babies with the bathwater. Software is one of the areas that I'm very interested in looking at, but I'm also looking at the industrials, the materials, the metals. I think a lot of areas in the market actually look pretty attractive after this discounting cycle completes. Now, obviously, it could get worse if the war continues to metastasize and becomes a greater regional conflict. This low will likely not hold. But that would be the first area I'd look for a reaction and then kind of take a sense as to what the temperature is out there in terms of the conflict as well if we get down here. The NASDAQ has a similar look to it. It also is looking like it wants to break below this range. It was able to pop right back into it with the trading yesterday. But I believe that this one also has a very top-heavy distributive look to it. So let's see if we do break down below. This would be back to the summer's lows. That would be another area that I would see as a buying opportunity in the NASDAQ. I don't think that breaking down to these lows is a bad thing. I think it flushes out late hands. It actually creates the potential for the market to make a more meaningful high because those same speculators have to come in and buy back at higher prices if prices start to move back higher. That's kind of the mechanism that really does keep the market moving. It's not just that mechanically people are continuing to put money in. It's also that there's a lot of traders out there that when you get these extreme moves, they tend to get shaken out and then they have to buy back in at higher levels to keep that price action going. Gold also continues to look pretty good to me. This is something we've been watching for quite a while, this channel that gold's been trading in, and it's honoring it quite well. We got right back to the top. We've rejected. My base case here is the next time we break above the top on a weekly closing basis, we're not likely to get back into this channel range. I think at that point, we're going to start to make that move up to 6,000. It could take some time to consolidate, especially this parabolic blowout move that gold had, but everything that was feeding into why gold has been rallying is still quite active. That is to say, all the reasons that gold made all-time highs, whether it's high deficit spending, geopolitical uncertainty, economic uncertainty, or the presumption that the Fed's in a cutting cycle, all those are very much intact. Silver, on the other hand, does not look quite as good. It broke down from a pennant. It's challenging the bottom of the pennant here. I'd like to see it break above that pattern to give me some sense that, the lows are in for now. But silver certainly looks more precarious than gold. And oil, it's a question of, is this time different? We've seen this kind of a pattern before. It's a bull flag breakout. This one's pretty huge, but we've sold off those highs aggressively. Now, the piece that we're seeing in oil markets, the relative piece, could be short-lived because the presumption is that this conflict is not going to last, that we're going to stop attacking each other's infrastructure, that the strait will open up sooner than later. If those presumptions prove not to be true, oil is very likely to continue its march higher. So I would not be terribly surprised for this to be a temporary lull, sort of an eye in the storm, if indeed geopolitical tensions do not fall. If they begin to appreciate from here, triple-digit oil is all but certain. And then we have Bitcoin, which continues to look pretty bad. We'll see if it's able to break above this next level around 72,255. If it is, I'll reevaluate the technicals on this. But for now, looks like a bit of a messy head and shoulders that confirmed that break and is now retesting some of these areas of resistance. If it can't break above here, if it continues to sort of look like it wants to roll over, and especially if we get below 60,000, I think we're destined to 52,787. And then we have the US dollar, which is a big determinant in how things like precious metals do, but also more importantly, emerging markets. The emerging markets trade is very crowded, but I do think it has reason to be bid higher. However, I'm not wanting to get involved until we see the dollar really start to weaken again, ideally breaking below this trend line that takes us all the way back to 2008. On that kind of a break, I think it would be time to buy gold with both hands. I think it would be time to buy precious metals, buy emerging markets with both hands. I think silver and platinum could also do well in that type of environment. And I think it would be probably good for US stocks because their earnings tend to improve on a weaker dollar as well. So we'll be watching this, but right now has me on pause with the emerging market bullishness because it's a crowded trade. And if the dollar rockets higher, that really tends to hurt those emerging markets where their debt tends to be priced in dollars, where there's hedging effects that can come into play. So we'll be watching very carefully how the dollar comes from here, basically, if we're able to see it break down or not. For now, it looks like a continuation of the uptrend. And then finally, we have our weekly pivots, and we are pretty well below these levels. So pretty close on the S&P, pretty close on the NASDAQ. S&P futures trading 67.90, NASDAQ futures trading 24,979. So pretty close on both of those. We are above on gold and silver. So gold and silver looking bullish coming into today. NASDAQ and S&P have a little more to prove. And I'm just posting this out on social. And then we're going to shift over to options insights. Taking a look at the S&P 500 here, we can see we've got a call wall up here at 7,000. We can see a put wall at 6,700. So those are going to be the really big levels to watch here. And I've got those mapped out. So you're welcome to take a screen cap of this as well. I'll also post it on social. But these are some of the levels that we're going to be watching this week. And like with everything else, even when it feels like it's all over, it really is just building up to the next time we're so bad. And I think that's kind of something we need to keep in the back of our head. Like, I know it feels a little crazy out there sometimes with everything that's going on, but ultimately, the markets tend to mechanically resolve higher over long durations of time. So you've got to make a shopping list. You've got to figure out what you want to buy when everything looks like it's going crazy. And when you do that, you can start to research those companies, figure out what qualifies them for a bullish structure. Is it an earnings play? Is it a technical play? Is it more of a macro top down view that you have that qualifies that? And then you can start looking for entry points. You can start looking at the price structure of the chart and determine where would I want to enter this stock and try to find multiple areas. Try to find what could happen in scenario A, B, C, D, so that you can really put out there how you want to get involved with a stock, an asset like gold, a region like, say, if you wanted to get long Korea or Vietnam or Malaysia, any of that, you've got to qualify. All right. So we're going to now switch over to Bookmap. Give me just one moment here. And the market is opening. Got a pretty sizable push off the opening bell here. Watching 6810.25. That's our major pivot. It's also our weekly bullish above pivot. That could be an area that provides a bit of resistance just overhead. Good morning, slow down. Good morning, low key. Good morning, Tom. Good morning, everyone else out there. What are my thoughts on the AI distillation trend? So I imagine you're talking about Western companies alleging that Chinese companies are distilling their models. I find that highly amusing. And the reason I find that highly amusing is because everyone that is building AI models is essentially scraping the internet, siphoning up petabytes of copyrighted information that doesn't belong to them, and then building models for commercial purposes and essentially leasing out those models for profit. And if you look at copyright law provides fair use for when you're not using it for commercial purposes. So OpenAI, Anthropic, Meta, Google, all these other companies hoovered up enormous amounts of information that doesn't belong to them, built models and are monetizing those models, which is technically against the law. It's not fair use to use other people's copyrighted work and essentially gain from it without permission and without remuneration. So that's all going on, and then these same companies that essentially pirated humanity's knowledge are saying, "Oh, wait, all that stuff I pirated that I built into a model, that's mine and mine exclusively, and you're not supposed to have any of that." I find that all very amusing, if I'm being completely honest. Like, what right do they have to say, "Oh, this pirated information that I stole is somehow, mine now," when it's not, arguably. I know judges have come on various sides of this issue, but my view is that, hey, if you're taking other people's copyrighted works and you're using it without their permission, you're not paying them for it, and then you're monetizing it, that is very much both immoral and illegal. So I'm not particularly concerned about the distillation trend because it seems like it's all fair game at this point. I mean, but also, like, just boiling it down, um, distillation is not going to, like, give the trade secrets of Anthropic to, say, ZLM or GLM ZAI. That's one of the models from China, ZAI Labs, the GLM model, or to Minimax or otherwise. It's just gonna help to improve some of the reasoning and responses, and, I don't see it as that big of an exfiltration. It's certainly not at the same scale as pirating up all of humanity's information and building models from it. Like, distillation to me would also be a lesser offense overall. So, that would be my 2 cents on it. Let me know if that is helpful. And that whole little rally we had off the opening bell, giving that back and then some, making some session lows here. Certainly well off the earlier lows. If we pull this back, we could see 830 had a meaningful low. Wasn't a data point, just, saw some selling into that. There was some aggressive seller absorption into that as well. We saw sellers once again getting a bit aggressive before 9 a.m. on absorption, and then a bit of an iceberg sell into this move lower here. So we're going to zoom back in. We'll take it to a 5 minute here. You could see that 484 iceberg. Not a small sell. It's not a very large one, but it's not a small one. And the market certainly reacted. This is also not a very liquid contract right now as we approach roll. So only 23,000 order book depth. Good morning, Matt. But yeah, I mean, going back to the broader markets, I do think we're in a precarious spot here. We've been trading in this range for quite a while, and breaking to the downside the way we have, with the amount of energy that break happened, does suggest there's room for continuation. And of course, the reflexive nature of this market to buy every dip almost just mechanically, as well as it being a pretty well hedged market, all makes sense that we would get these sort of lower highs and then lower lows, and kind of build that structure where there's a fight off the low, but we don't quite get back to that prior high. It sort of feels like that's what we're building on this leg down. Obviously, we need a little bit more sample data or price action to confirm that. But the way we closed out last week, and the way we reversed yesterday, which was, it was a reversal, but it wasn't a incredibly convincing reversal. Let's put it that way. Does suggest we could still have some weakness here. Plus, ultimately, it's not a bad thing. to shake those weak hands out. This has been a market that's been incredibly forgiving for some time, really since November of last year. And then before that, since April, shaking folks out every once in a while is good for the overall market. It also allows us to get better entries. So I'm not going to be too concerned if some of my longs in my portfolio get beaten down a little bit more so I can deploy some of my cash to buy some of those same companies and others at better prices. Always got to look at this from the longer term perspective. Now, if you're all cash deployed, fine. And if you're in good stuff, you'll probably be fine. If you're running leverage, you might not be as fine depending on how much leverage you're running, especially if it's time sensitive leverage like options. That's where I would be a bit more careful. A little bit of a pull here, seeing some increase in seller aggression as well. Seeing that in the larger delta bubbles, which are indicative of essentially more sellers appearing on the tape than buyers, making a new session low on that as well. Gold is surging, making a high of 5238.90 before pulling back just a bit to 5228.10. Silver also having a nice run here, up 5.79% to 89.35. Oil, on the other hand, pulling back, crude oil down to 87.48, down 7.27%. Let's take a quick look at gold here. And we could see that pop earlier that got us to the session high, pulling back just a bit from there, but gold looking very constructive overall. We're just going to take a 3 hour view. We can see that big rally off those early morning lows. And what's noteworthy about gold here is it's defending the 20-day moving average. We didn't even get back to the 50-day moving average. That tells you the kind of demand there is for the stuff. Plenty of worries about the future. That's another reason people love to buy gold. They're concerned about what's my money going to be worth next year, 10 years from now, etc. Debasement. There's no reason to be less concerned about debasement now, especially after hearing headlines like Trump wanting to upsize the defense budget to $1.5 trillion. So to me, I think gold is something that, one continues to look at accumulating into weakness if it fits one strategy. For me, it does. So for the way that gold's been trading, when it has these big sell-offs down to major levels like the 20-day, that's where I'm willing to nibble because you have a very clearly defined risk to reward area. You know that if gold breaks below the 20 on a closing basis, you get out. And if it's back up above the 20 and it's holding it and it's testing it, continuing to hold above, you get in and you stay in. That's the average that gold's really over the last several trading sessions been giving us a heads up about. That as long as it's closing above there, it's got some room higher, and that's what it's doing here. It's got a nice close above. It's making that push. The next level below there is the 50-day, which has also been where gold tends to bottom out after some of these sells. Like we saw the Jan Feb sell bottom out right there around the 50-day moving average for gold. So worth looking at. This is a Bollinger Band squeeze breakout that's been going on for years, and I think it still has room to continue at least up to 6,000. That would be where I'd be looking for it to go this year. And that's not that much higher than where we are now. That's less than 20% from where we are now. Gold getting a little bit of a sell off of its high. Let's take a look at Bitcoin as well. We talked about this one trying to get off of its, sort of just really nasty downtrend it's had since fall of last year. And it's just looked like lower highs to lower lows. To me, it gets these long periods of consolidation and then it just breaks down. So I'm just going to pop that chart over here real quick. You've got this sort of, rolling over pattern. So, you make a lower low, lower high, lower low, consolidate. You make another kind of lower high here, a major lower high versus like a minor lower high. You make a major lower high, then a major lower low, and now we're kind of back into this consolidation pattern again. The primary trend structure suggests we could continue to move lower on this. So that's why I would be careful on Bitcoin unless and until we're able to make a meaningful reversal. For now, it's still in a pretty nasty bear market. Switch back to the S&P 500. And Loki has another question on AI, and I'm happy to answer anyone's questions, by the way. If you have questions, just let me know. I'm happy to help. I do want to make sure that folks that are tuned in gain something, learn something. Okay, I also see a question from Steven earlier. Steven, I'm sorry I missed that. So let me get to Steven's question, then Loki, I'm going to get to yours. Steven asks, how are you able to pull this data, the slides with graphs, and where do you go about it? I'm curious if you trade options with your futures and how or which you prefer one over the other. And those are both really great questions. So let me get to these real quick, and then I'm going to get to Loki's question about AI. So for the charts, I have a number of different things that I do. I have, things that I've subscribed to that provide data services. So some of those charts, like bank charts, will come from there. I have charts that I create myself, like you might see the options charts. Those are all pulled from the tools that I've built. This what was the SPX options visualizer, which is going to become Options Viz, is where all that data comes from. And essentially, it's just a group of tools that I built, including an algorithm that can analyze the entire structure of options for a stock, ETF, or index and break it down into charts and into levels. So that's where that stuff comes from. Um, and then the charts is all just basically going out there and finding them from various publications and just doing research and building my own charts where I can as well. Like some of the other charts, the price charts are largely from FinViz. I really like their charting platform. Um, and then your other question about if I trade options with my futures. So I tend to be pretty flexible in what I like to trade with. I will trade shares. I'll trade ETF units is what their pieces are called. I'll trade futures. I'll trade options. I'll trade Forex. So I'm pretty flexible. I really just like to look for situations. for my framework where macro and momentum are meeting. That's the sweet spot for me, where there's top-down reasoning behind the move, and then there's structure within the move that also, um, kinda gives you a sense as to the directionality. So both kind of meet in the middle and give you a pretty clear idea as to where this may be going, especially if it's earlier stage. For that kind of setup, it's really about what makes the most sense to express that view. So I love futures personally because futures tend to allow me to be much more flexible in my positioning. And hold on, let me just deal with this visual issue. Okay. So, with futures, I can trade around the clock. Like it's basically closed an hour a day and on the weekends. So much easier to balance your risk out in that type of situation. Like for me, it's much easier if I have a position on and I'm going to stop watching it for a bit. I can have my bracket order in, but I can also know that when the market's, the stock market's not open, I can still get stopped out on my futures position. And I see that as a good thing. I can realize risk exceeding my comfort level whenever the market's open. And so that helps a lot. It also helps because you don't have the same kind of wash sale restrictions here in the US. If you basically have like a loss and then you take another loss within 30 days or less, you can't deduct that. And obviously, with trading, there's going to be losses, there's going to be wins, and you want to be tax advantaged in how you realize all of that. So, futures give you better, I would say, tax advantages in that and 60/40 treatment. So, I prefer futures overall where I can express my view. There's even sector futures like for energy, for tech, for finance, etc. They're not super liquid, but they're cool for swing trading vehicles. Options I like a lot where there's opportunity. Like sometimes you'll find opportunity in the trend structure, the term structure, I should say, where you might have volatility that seems pretty expensive at one part of the calendar and volatility that seems pretty cheap in another, setting up a better debit cost for a spread trade, whether it's a diagonal or a calendar spread. So I love options for spreads. I don't tend to use them as much like just buying calls or just buying puts. If I'm buying puts just alone, it's typically part of a hedging strategy, but I love using spreads. I also love using options against a position. Like, I have Palantir in my portfolio. I'll sell calls when it gets wildly expensive, especially when it's the valuation and the volatility. I'll sell calls into that, and then if shares get called out of my portfolio, I'll sell puts until they get put back into the allocation I want. I do the same thing with some of my other long-term holdings. It just, if they're optionable, if they're liquid and they get those vol and fundamental blowouts, it makes a lot of sense to take advantage. So I use options a little bit differently, I guess. Um, I don't tend to just like, I will sometimes do things like leaps, but I don't tend to do much of the shorter dated stuff unless it's like, you know, just much smaller size degeneracy. So if I'm day trading options or if I'm short dating options, those are much smaller sizes than some of the spread trades and other strategies that I might be putting on. But to answer the question overall, I like both. I like futures and I like options, and I think they're both very useful tools for different use cases in trading for the way that I look at. And then do I trade 60? I mean, I trade euro. I don't trade euro futures as much. I haven't traded forex as much in a bit. I've just been more enamored by what's been going on in commodities and some of the sector rotations. But when I was trading forex, I was typically rolling with either the just like rolling cash, like basically just trading the pairs, or I was trading options on the ETFs. Selling options, how far do I look out? He's asking. So I tend to look out. I mean, I look at the term structure and try to get a sense as to where there's premium that could be harvested that like outside of things like known in advance events like earnings, where there might be a premium that I can sell against to try to capture that. So there's some variability. It's not like a hard and set line, but I tend to look out between 2 and 6 months. That tends to be the sweet spot for me because I do like to have it be a bit of a rotation. And there's so much that can happen, in a year or more that I don't feel comfortable going out beyond 6 months. On the other side of it, premium starts to run off so fast that anything shorter than 2 months tends not to be worth it to me. And then, low key, you were asking about distillation. So, what you've gotta really look at with distillation is basically interacting with an AI model and then having takeaways, like, training data that you create through that interaction. So, you might ask it a series of like, programming questions, coding questions, data analytics questions, whatever. You might ask it a bunch of really specific, challenging questions, and then you get those questions and answers, you match them together, and you use that as training data for another model. So, it's like you're not getting the insides of the model. You're getting its reaction function to certain types of queries. And so will that help you maybe make another model smarter? Sure. If you look at Hugging Face right now, and if you don't know, Hugging Face, despite its very silly name, is actually a pretty important website in the open source AI space. It's where you can go and download models that you can host on your own system. And I do all of my AI stuff locally. It's all local inference. I've got a pretty cool rig for it. So there are models on there, not to digress too much, but there are models on there where they are built on, in part, a foundation model and then distilling against another model. So there's one on there right now. Quen just released a new series 3.5. That's the lab from Alibaba, where their lead was just unceremoniously forced out. Not really sure exactly what happened there. I'm going to have to dig into it more. But they made a really great model with Quen 3.5. And one of the smaller versions of it, 27B, it's a 27 billion parameter model. It punches way above its weight. So it's punching into 100 plus billion parameter models in terms of its benchmarks. Someone took that already very capable model and ran a training against it, basically using distillation data from Opus 4.6 from Anthropic. And it supposedly makes the model smarter. To what degree, I don't know. I haven't personally tried it out yet. The reviews are mixed overall with this and other similar types of runs. That is to say, distilling data and just trying to train a model against it is not like a universal upgrade. It can kind of make things go sideways. It can even distort the model. If the person doesn't really know what they're doing, it can make it much worse, even break the model. So I just want to start with that. Like, this is already kind of a precarious way of adding data, especially to an existing model. Maybe if you're building a model from scratch, it's, I imagine, far more easier. I haven't personally done that yet. For AGI, so first I would imagine that with the concerns that OpenAI and Anthropic have put out there about distillation, they've probably further locked down their APIs or what you use to query their models uh, to try to detect patterns. It's not to say it's going to be perfect. There's all kinds of ways you could distill that could be pretty creative and seemingly random noise in the grand scheme. But I would imagine they'd at least try to do certain things to counteract it. If and when we get to the point that there's AGI, to your question specifically, is it going to be better at detecting distillation and be able to block it in real time or shortly thereafter? Maybe. I mean, I imagine if we have AGI, it'll be a lot more aware of a lot of things. If it is indeed AGI, we're already calling something AI that it's questionable whether it is AI. Right now, what we have are really nifty probability engines. They take different sets of data, they put them in a multiplication matrix, and they interconnect based on the probabilities as to how a model should take the information that you've given it and parse it, and then how it should respond. So it's not really intelligence, it's really beautiful math. This is why you get hallucinations sometimes, because probabilities suggest that good enough is good enough. So, in a nutshell, it's also a question as to whether what we have right now is really AI. I think it's getting closer. And I think the next stage after large language models, which, by the way, Google invented in 2017, this is one reason they're such a formidable player in the space. They've been here for a while. But once we move beyond probability engines, I think we're going to get something that resembles AI much more closely. This is a stepping stone. It's progress, and it's getting better even within LLMs. Like the newer LLMs are getting smarter, density of intelligence is improving. But I don't think distillation in and of itself is going to be a game changer for the labs that are doing it or for the people that are trying to protect against it. I don't think that's going to help them keep their moat. I think that what ultimately happens in this space is you see density of intelligence continue. I started talking about this last year, that density of intelligence was a really big deal, and we're going to see a bigger race into smaller models that can do more. That has, over the last year, become the trend, especially in open source. So stay tuned for that. And I got off at a little bit of a tangent about AI, but I hope that was at least helpful and informative to folks out there that are tuned in. Always love talking about this stuff, markets, technology, business, etc. It's a blast. I will be back next week, same time, 9 a.m. Eastern, for the next episode of Back to the Futures. And as always, if anyone has any questions, reach out anytime. Happy to help. Thanks for tuning in. Catch you soon.